Welcome back. Inflation is top of mind today with the latest CPI data easing to 4.9%. That's on an annual basis. So what does this mean for the average American? Joining us now to help demystify some of this financial terminology for retail investors is Ross Mack of Maconomics, who is helping to close the gap between Wall Street and Main Street. So, Ross, thank you so much for joining us. I know you've been on the program before. So let's start out with this. When you have a day like today, some fresh econ data coming out that is very much consumer focused data, what is your top takeaway from this?
I think the top takeaway, well, one, thanks for having me. I think the top takeaway you have to say is, okay, we're trending in the right direction. That being that inflation is starting to tick down, right? We've seen this over the past maybe 10 months or so, right? But I think we have to also understand what the Fed has been doing, right? Jerome Powell has been very straightforward with what he's saying, right? We are a long ways away from our 2% target. And so what does that mean, right? I think there's still uncertainty left out there, which might mean, is the Fed going to continue to raise rates? Is there going to be a deal done when it comes to debt ceiling? I think at the end of the day, I think what we understand is that prices are starting to come down, but we still are a lot ways away, right? So I think they just have to say, what impact is that going to have on the markets?
Ross, I want to pick up on what our Shauna Smith was saying when she was speaking with some executives over at the Goldman Sachs conference, because there does seem to be a real divide between what appears to be some caution, but maybe even a little more optimism on Wall Street versus what we're hearing on Main Street. What do you make of that divide? I mean, what are you hearing if it is about Main Street and where consumers are right now?
Well, so when you take a step back and you were at the Goldman conference, if you even go back this past weekend and you see what Warren Buffett and Charlie Munger were saying, at the end of the day, we have to understand there's a lot of different moving parts, right? We look at the overall inventory glut. We see that rates are constantly going higher. What are companies doing in order to continue to cut costs? Is the labor market still too strong? Does that mean the Fed is going to have to raise rates to kind of counteract that? Or are companies saying to themselves, okay, if there is going to be a slowdown in the economy, how are we going to continue to find ways to cut costs? Does that mean we lay off people, right? Especially when it comes to the inventory glut, when so many companies, due to different supply chain disruptions, were saying, let us over order in order to be ready. And now they're seeing consumers not willing to spend as much or not shopping as much, right? And as a result, a lot of companies are now lowering the prices, right, are starting to put out sales. So at the end of the day, what we're starting to see, right, with earnings, we got some mixed earnings, but we are starting to see a little commonality when it comes to forward forecasts. And a lot of companies are expecting to see some slowdown. And so when we talk about, Main Street, I think that some of the things that we have seen is credit card debt is among all-time highs, right? And so at what point do consumers stop spending and businesses try to find other ways to counteract that? Will that lead to more people being fired? Or, so we're seeing, certain jobs laying off people, but the overall economy, we're still seeing a lot of strength. So do we have more room to go?
Yeah. So, Ross, yes, to your point, I mean, the recent jobs report came in stronger than expected. So it shows that there are jobs out there, although some people would disagree with that. People who are, being laid off right now. We have company after company announcing layoffs, whether it's the tech sector. Now we're seeing some job cuts in media and entertainment. So what is your audience is looking to you often for advice, for personal finance advice. And you come from a Wall Street background. What's your advice in terms of preparing for a downturn? Because we have talked about the potential for a recession this year. What's the advice? What's the top 3 tips that you give your audience?
I think that's a great question. I think if you asked any economist towards the end of last year, everyone was saying a recession next year. Everyone was saying S&P is going to be flat to down year to date. And as you look this year, right, the market is up, right? But what I will say that in the event there is a recession, right, I don't think your overall strategies when it comes to investing in dollar cost averaging should ever change, right? And that is when you really want to remain disciplined and be a consistent investor. Because I think what happens is when people start listening to the headlines, there's a lot of people, one of the greatest quotes from Warren Buffett is, be greedy when others are fearful and be fearful when others are greedy. And that's one of the reasons why the market is higher, right? But I think that as you continue to take a step back and say, okay, it's impossible for the average investor, even the professionals, to time the market. So how should I think about investing? And I think the number one thing to do is remain disciplined and consistent and continue to dollar cost averaging by investing on a monthly basis. And outside of that, I think that when people start analyzing their own personal expenditures, right, inflows and outflows, I think it is prudent to literally be finding ways to cut costs. That way that you could actually build up a cash reserve in the event there is a recession, which historically will tell you that is the single best time to actually invest. And so remaining disciplined and also having some cash stockpiles so that you could take advantage of in the event there's any dislocation in the market.
Yeah, I'd imagine a lot of people taking a second look at their expenses right now. Ross, thanks so much for that. Ross Mack, creator of Revolt Maconomics.